Okay, so that is the FAC3761 October-November final exam of 2022. So what I'm going to do, I'm just going to read the introduction for the whole question, and then I'm going to focus on the revenue aspect. I'm not going to read the entire question, so just the revenue aspects and then the general part of the question, and then we'll go into then we will go through the required, and then I'm just going to show we need to think about the certain issues that we needed to consider when dealing with this revenue question. Okay, so there's going to be that, and then additional information number 1, and that should be all. We're just going to check. Yeah, that'll be all basically. Okay, and then I'll read the required. Okay, so say Kalahari is a vehicle wholesaler and retailer based in that place in South Africa. The company is listed on the Botswana Stock Exchange and has a 30 September year end. Okay, so there is basically 2 to 3 important issues over here. So one, the year ending 30 September. So that means we're running 1 October to 30 September. So kind of want to write that down. Then we are listed on the Johannesburg Stock Exchange. So that that will just be, I mean, not the Johannesburg, the Botswana Stock Exchange. So that basically just triggers foreign exchange, because we in South Africa and we have a forex. So we almost likely have some transaction that is based in Botswana or something of that nature. So there may be forex, but that may be a separate part of the question. Okay, but that's basically the second thing to take note. Then the third thing that is very important, we a vehicle wholesaler and retailer. Okay, so that means we buy and sell vehicles. So that implies vehicles would be our inventory, because that is what we do in our ordinary course of business. So that's important to take note. So just keep it in the back of your mind. Okay, so then they have exchange rate assumptions. The following dates and exchange rates are applicable. Okay, so we have the different dates over here: 1 March 2022, 1 June, 30th September, and then the average for the period. Okay, so they say you may assume all amounts are material, ignore implications of VAT. Kalahari uses the perpetual inventory system, and contracts with customers meet all the criteria of IFRS 15, paragraph 9. Okay, so that is basically that. Then there's a taxation. Deferred tax is provided for on all temporary differences in accordance with the Statement of Financial Position approach. There are no other exempt or temporary differences except those mentioned in the question. There is certainly beyond reasonable doubt that the company will have sufficient profit in future against which any deductible temporary differences can be utilized. So that just is, I'm not now gonna remember if FAC3761 deals with deferred tax or if it is FAC3762. But basically, all they are telling us over here that if we have a deferred tax asset, we can raise the deferred tax asset. Because what's important to take note, when we have a deferred tax asset, we need to ask ourselves a question: can we recognize the deferred tax asset as an asset? And what will allow us to recognize a deferred tax asset as an asset on the Statement of Financial Position is if we will have sufficient taxable income in future periods. If we won't have sufficient taxable income in future periods, then the deferred tax asset will be limited to what we will have, or it will be limited to the deferred tax liability. So that's just important to take note over there. So in this case, there's no problem. So whatever deferred tax asset we calculate, if we calculate, can be recognized as an asset. So that's just that part. Okay, so now we're going to do additional information. We're only going to focus on additional information number 1, is 1.1 and 1.2 deals with IFRS 15. So they say the following transactions have not yet been recorded in the accounting records for the year ended 30th September 2022. So that means our financial year end is 30th September 2022. So we're running from 1 October 21 to 30 September 22. So 1.1 is a contract with Moremi Game Lodge. So on 1 March 2022, okay, so remember our financial year, 1 October 2021 to 30th September 2022. So this is within the current financial year. So on 1 March 2022, Kalahari sold and delivered 15 electric Road Ranger bakkies to Morimo Game Lodge for 825.038 Botswana per bakkie. Okay. So what's important, take note, on that date, we sold and delivered. So basically kind of like the risk and rewards of ownership transferred on that date. So technically speaking, we should be able to raise revenue at that date. Because we're selling a vehicle, it implies that it happens at a point in time as opposed to recognizing revenue over a period of time. So therefore, we need to know when is the date that the risk and rewards of ownership are basically transferred from us to the buyer. Okay, we are the seller to the buyer. So that's basically 1 March 2022. And that's, I'm only at this point, right? I'm only at this point, and that was going through my mind. I never yet read the term, the sales agreement. So once we read the sales agreement, we will see whether that still takes place. Okay. So 1 March 2022 is an important date because that's when we delivered the items. So they say the sales agreement stipulated the following contract terms. The total consideration of 825 per bakkie will be paid on 1 June 2024. So take note of that. We sold this 1 March 2022. We're only going to get the money on 1 June 2024, which is kind of 2 years from now. So that automatically indicates a significant financing component. So we need to consider the significant financing component. What does that mean? Then they say Moremi may return any of the bakkies within 90 days from the date of purchase. Okay, so point number 1 is a significant financing component. Point number 2 is a return policy. Okay, so with the first point, significant financing. So we know there's a financing component because we're not paying, the amount paid is at a later stage. So the question we need to ask ourselves is that financing component significant? If it is more than 1 year, it is significant. Okay, if it's less than 1 year, then it is not significant. IFRS 15 says you don't have to worry about anything, but when it's beyond 1 year, then we need to consider, then it's kind of basically a significant financing component. Okay, so we can see it's 2 years later. So it is a significant financing component. So we need to see what we need to do with that. Okay, the second point is a return. There's a return policy. So when we have a return policy, we basically, when we recognize revenue, we have to recognize also a rate of return. But there will be some important points regarding that rate of return that we will discuss just now. Okay, then there's an interest is payable on a pre-tax market-related interest rate of 8.25 per annum compounded annually. Okay, so this is just basically for that significant financing component. Because we are paying 825 in 2 years' time, we need to get the current value, the present value today. So the way we're going to get the present value is to discount it using the market-related interest rate of 8.25. Okay, so what's very important, take note over here. This is an important difference when you compare financial management to FAC. Okay, so in accounting, we always use the pre-tax rate. Okay, in financial management, we'll use the after-tax rate. So must just be very careful to see what do they give you in accounting. Are they giving us the pre or the post? We always want the pre-tax. And the reason for that is, from an accounting perspective, every income, every cost need to be a before tax amount. Why? Because we have a separate line item that deals with tax called income taxes. Okay, so just always be aware of that. So that maybe in a third year level, they won't trick you on that. On the CTA level, they could potentially provide you with a after tax rate, and to see if you must actually use the pre-tax. Okay, so always just be aware of that. In accounting, we use the pre-tax amount. Okay, so that is just basically to discount this 825. Okay, so they say the bakkies are new to the market, and Kalahari sold these bakkies for the first time to Morimi. Kalahari has no relevant historical evidence of return or any other available market evidence. So this here is extremely, extremely important. This impacts the return policy. So when you have a return policy, the accounting IFRS 15 basically wants you to recognize revenue based on what you expect you will receive. Okay, so you sold 15 bakkies, but that does not mean you expect to actually receive money for 15 bakkies, because perhaps on past history, for every 15 bakkies, 1 bakkie gets returned. So in effect, you only expect to receive 14 bakkies. So the accounting standard wants us to recognize revenue based on what we would expect we will be earning. So if past history says for every 15 bakkies, 1 bakkie gets returned, that means we only expect to earn revenue for 14 bakkies. So that means we'd have to recognize revenue and a right of return. Okay, but you can only recognize a right of return if you have evidence of based on history or market evidence of what would actually happen. Okay. So in this case, we have no history, we have no evidence, because it's the first time you're doing it, and there's no market history regarding this as well. So that means we don't know what the right of return would be. That means we don't actually know how many bakkies would be returned. So therefore, from an IFRS 15 point of view, we cannot recognize any revenue on 1 March 2022. The reason being is we don't know how many of that 15 bakkies will actually be returned or not. So the only time we can recognize revenue is once that return policy is over. So in effect, we can only recognize revenue 90 days later. Okay, what kind of give this away? We sold it on 1 March 2022. The return policy is 90 days, and we're only going to receive the money 1 June 2024. So if you think about it, it is March, April, May. So therefore, we can only recognize revenue on 1 June 2022. So from 1 June 2022 to 1 June 2024 is exactly 2 years. So that was kind of like, you could also pick up that there's a you must pick up, like, how can I say, it was kind of like a clue, if I can put it that way, that you can't recognize revenue on 1 March 2022. So why can't we? Only because we have a return policy, and only because we don't have a history regarding the return policy. So IFRS 15 make it crystal clear that when you have a return policy and you don't know how many would be returned, you don't have any history, there's no market evidence, then you can't recognize any revenue until that return policy is over. Okay, so until so basically until it expires. So only after 90 days. So that means from 1 March 2022 until 31 May 2022, that is 90 days. So we can only recognize revenue on 1 June 2022. So then we would know exactly how much revenue to recognize. Okay, so just take note of that. However, on 1 March 2022, we did how can I say now, we have delivered, right? So we have delivered the vehicles. So the inventory went out. So we can basically say credit inventory, and we can I can't, like the question is, do we debit cost of sales or not? So that's kind of like the tricky part over here. But basically, we can credit inventory, and we can debit, we have to debit something. Okay, so we have delivered, so they kind of have to, we have to recognize something on 1 March 2022. Perhaps it would be a income received in advance, not income received in advance, it is basically a contract asset or something of that nature. Okay, so we have delivered, but we can't recognize revenue. So we're going to have to recognize something to take into account the fact that someone owes us money. Okay. But the revenue aspect is on what we can't recognize revenue on 1 March because of the fact that there's a return policy, and we don't know how much of the return, how many buckets would be returned. So we don't have historical evidence, and we don't have market evidence. Okay, then the Kalahari purchased an electric road ranger bucky for $735 from its supplier. And then here they say, none of the electric road ranger buckies were returned during the year. You may ignore any expected cost to recover the returned electric road ranger ecstasy buckies. Okay, so that is that one. So let's quickly do a journal entry. Okay. So basically the two important aspects in that question was, what was it now? It was the right of return and the significant financing component. And for the right of return, we couldn't recognize anything because there was no history. Okay, so what would have normally happened? Okay, so what would have normally happened would be as follows. So 1 March 2022, you can see Excel, right?
Yes.
So 1 March 2022, okay, so on 1 March 2022, what would have normally have happened is as follows. We made a sale, so we're going to say revenue, SFP, and it's on credit, so we'll have debtors. It is debtors. It is, sorry, this is SFP. This is what we call it. What we call it, P&L, yeah, P&L. P&L, SFP, P&L, revenue. Okay, and then we'd have trying to think, revenue. Okay, and then we would have right of return asset, and then we would have what do we call it now? Right of return asset. I'm just trying to think, okay, what is it called? David, right of return. It's slipping my mind what we call this thing now. Right of return asset. It would be cost of sales. And this would be inventory. So in a normal circumstance, this would be an asset, SFP. Okay, this would be P&L. And this would be SFP. I'm not going to put the, so what would happen is we sold 15 vehicles, right? So this would be 15, the cost price of the 15 vehicles, which would be the 735 times 15 times the exchange rate. And let's just assume the return policy is for every 15, one is returned. So cost of sales will only be 14 and rate of return would be 1. So here you can see debits are 15 and credits is 15. Okay, but not the full 15 doesn't go to cost of sales. 1 goes to rate of return asset. Now remember, this is based on the cost price. Okay, over here we'd have the selling price. Okay, so the selling price 15, the debtors owe us for 15. Revenue, we can only recognize revenue for 1. And then over here we would have 1. This would be a liability. What is it called now? I cannot remember what it's called. SFP. Yeah, that would be 1. I'm just going to call it for now provision for return. I cannot remember the term. I'll have to look now for the what's the you don't have the accounting standard? No, yes. Do you have IFRS? No.
Is it? No,
So in
the
I don't have the I don't have the examples. So the journals is in the examples. I can't remember. There's a specific name that is given. Okay, it's not exactly called that. Definitely rate of return asset. Definitely called that, but it's not called that. Okay, but let's just call it for now provision for return. Okay. But what's important to take note, this would have been the journal had there been a historical evidence or had there been market evidence. Okay, now because there isn't, this journal can't take place. Okay. So this journal can't take place because of the fact. And remember, will be the actual amounts. I didn't put in the amounts. Now I'm just showing the quantities. Okay. So remember, for the revenue, it'd be the selling price. For the cost of sales, it would be the cost price. Okay, times the number of quantities. Okay, so just take note of that. Now, okay, so over here, so that is basically what we would have over here. Okay. But so in this scenario, because we can't recognize revenue. We can't recognize anything got to do with revenue on 1 March 2022. Because we can't recognize revenue, the accounting standard allows you that you don't have to recognize any cost of sales, okay? Because we want to have that matching aspect. So how do we deal with the fact that inventory have left the company on 1 March 2022? So on 1 March 2022, inventory did leave the company. Okay, you happy with that? Because we physically delivered the buckies. So that means inventory we have to say inventory have decreased by 15 times 735 times the exchange rate. Let me just see if it was the exchange rate now. Okay, so purchases and electric, okay, so that is fine. So on 1 March, the exchange rate was 128. Okay. Okay, so this would be equal to 15 times 735, 123 times 1.28. Okay, so that is important to take note. But now for every credit, there must be a debit. Right? So what is the debit? Usually the debit would have been cost of sales. But because we did not recognize revenue, we wouldn't want to recognize cost of sales. So the accounting standard allows that you don't recognize any cost of sales. Okay, because just think about it, companies wouldn't want to recognize cost of sales, but they can't recognize the revenue. That would have a huge impact on their profit or loss. Okay, so the accounting standards acknowledge that. So they say, okay, you did not make a sale, so there shouldn't be cost of sales. But inventory have left the business, so you have to recognize a journal. So we have to credit the revenue. So what do we debit? So in this scenario, the accounting standard allows you to recognize another asset, okay, called a contract asset. So this makes sense. So what you realize is that nothing impacts the income statement, and it's just basically a swap on the balance sheet between one asset for another asset. And this is important because inventory is not there, right? We can't leave it as inventory. So some people may say, okay, what's the point if the balance sheet is remaining the same? It's simply decreasing one asset and increasing another asset. So why don't we just do nothing? But in reality, we can't do nothing because the buckets are not there. So it can't be, so there is no inventory, right? And so there's no inventory. And by saying it's a contract asset, it's telling people that we actually have a sale happening, but it's still need to take place, kind of a thing. You understand? So some transaction happened, but the revenue have not yet been earned. Okay, so that's basically what's happening over there. So that's happening on 1 March 2022. Can't recognize revenue. Why can't we recognize revenue? Because we don't have, there's a what do you call it now? There's a return policy, and the return policy has no history. So as a result, we can't recognize revenue until the return policy is over. The return policy is over now on 1 June 2022. Now we can recognize revenue. There's no need to recognize a right of return or a provision for return. The reason why the reason why it's because what's it now? It's because the 90 days have passed, nothing have been returned. So the return policy is now expired, and we know nothing has been returned. So therefore, the full amount can be recognized as revenue. Okay, so now we're going to say debit. So now we can recognize revenue. We have earned the revenue. So we can say credit revenue. For every credit, there must be a debit. So when we make a sale can be one of two ways, cash or on credit. If it was cash, we say debit bank, but we know it was not for cash. So therefore, we have to say debit debtors. Okay, and this would be SFP. Okay, we'll come to the amount now. And now we can recognize cost of sales. Because there was a sale, we can now recognize cost of sales. Okay, and this will be P&L. For every debit, there must be a credit. When we recognize cost of sales, we usually recognize it against inventory. But we have already accounted for the inventory on 1 March 2022. So now that contract asset is no longer a contract asset. We have fulfilled our responsibility. And as a result, the contract asset is no longer there. We can now de-recognize it. So it will simply be the 15. Okay, so you're happy with that, right? Now we must deal with this debtors. Okay, so remember, there's because that amount is being paid in 2 years' time. So therefore, it is a significant period. So therefore, it is considered as a significant financing, and as a result, we have to do a present value. So the workings over here would be workings. We need the present value. We know the future value. We know PMT, we know N, and we know I. Okay, so this is what we want. Okay, so we want the present value. So that's why I have that on top. Okay, the future value is, what was it amount now? The future value is 1 June 133, and it is 8, what was it? 825,038. 825,038. So it's going to be 825,038 multiplied by 15 multiplied by 1.33. Okay, so that is basically the future value from a so at that date they owe us that amount. Okay, so at whatever this thing, they owe us this amount. Okay, so 825. So the future value is 825,038 times 15. Okay, so that is the amount they owe us in Botswana, but we need to know from a rand value. Okay, there's no monthly or recurring payments, so that is 0. PM is once per year, and it's 2 years, and I is 8.25% per annum. Okay, so now I can say equal present value. Okay, so they want the rate, they want the number of payments, they want PMT, they want future value, and then they want it's the end of the period. Okay, and then okay, so that is basically the revenue amount that I will recognize. That's the present value. So the present value simply going to be that amount, 14,046. So every year I will recognize interest and interest income and or interest expense, depending on whichever way it is, and I'll recognize that until 1 June 2024, and at 1 June 2024 the debtor amount would equal to that 16,459. Okay, so there we go. So that is basically that. So on 1 June, so now the last thing I have to recognize is the interest. Okay, so remember our financial year in is 30th September 2022. Nothing have been paid at this point in time, but interest have been incurred. Okay, so what's going to happen over here is the debtors is going to increase, and interest would be earned. Okay, so you can either add it to debtors or you can have it as interest receivable, doesn't matter. Okay, so we are earning interest, so I'm going to call it interest receivable, or debtors, doesn't matter, you can take it to the debtor. Okay, it's going to go to SFP. Okay, and then we're going to have interest, income, P&L. So the way interest is calculated, it is the present value, okay, multiplied by the percentage, multiplied by time. So the present value is 14,046,271 multiplied by the interest rate of 8.25%. That is a per annum amount, but we're only earning interest for June, July, August, September, which is 4 months. So 4 divided by 12. What is that? Multiplied by 8.25% multiplied by 4 divided by 12. So those are all the journal entries relating to revenue. Okay, so as you can see on 1 March, we had to recognize that the revenue, the inventory have left, but we couldn't recognize any revenue because we had a right of return, and the right of return had and the right of return policy had this is what it's called. Yeah, I got the name now. This is called a refund liability. Okay. Refund liability. So the right of return policy is 90 days. We did not know anything about it. We have no history, no market evidence, so we can't recognize any revenue at that point in time. So, but because we had to recognize revenue, we take it against a contract asset. We don't take it against cost of sales because we did not recognize revenue. We want to match for income statement purposes. So therefore, we are allowed to recognize a contract asset. At 1 minute, the thing is going to cancel, then I'll send you a new invite. Okay, but then so that's why we did that. On 1 June, we can recognize revenue. We don't recognize any refund policy because the 90 days have expired, so the refund have expired. So all 15 can be recognized, but we needed to do a discount because it was the amount they gave us is only paid in 2 years' time. So we needed to calculate the present value. Then we recognized cost of sales, but we took it against a contract asset because we already took the inventory on 1 March. Then at the end of the year, 4 months have elapsed from the date the revenue was recognized. So we have earned interest income during that period. Okay, so you'll see the data would increase over the 2 years until it reached the future value of 16,459. Okay. There's no cash flow that took place during this time.